Yeah, we do know his letters tend to have a really ripple effect on where investment goes from here. But what was the main takeaway?
Well, the main takeaway basically is to go into passive funds because you're going to expect returns there more than active funds. And he quoted one number, $100 billion on basically what actively managed funds are wasting in terms of investors' money over the past decade or so. He was a little bit playful in his 29-page note. He likened active investors to monkeys, but he said he's only met 10 successful active investors here. But the bottom line is to let the tide take you out and you can reap the rewards. Now, the proof here is in this $1 million bet that he actually had with Protégé Partners. This is a U.S. asset management firm. And it's been over the course of the past 9 years, ever since 2008. And he challenged them to pick a set of hedge funds, and you can see the return right there, 2.2% over the past 9 years versus a low-cost Vanguard S&P fund that Warren Buffett himself has invested in, 7.1% of a return there. So you can see the stark difference. Now, if we break apart what Protégé has actually invested in, it's 5 funds of funds, 5 hedge funds here, and you can see those returns, Fund A, B, C, D, and E. Fund C, you can see 63%. That's pretty good, right? But then you remember that there are also management fees. And Mr. Buffett says that they take away about 60% of the gains there, compared to, of course, the S&P tracker, which is 85.4%. Fees we know are much lower. Hence, it's more interesting and better for investors to go into those passive funds. Now, one thing Mr. Buffett did say, he said that he knows that there are a number of smart people who are doing this job here, but he said that their IQ can't overcome the costs, always being just a little bit cheeky there. So if Mr. Buffett wins, and he is expected to do, then basically the money for this is going to go to a charity of his choice in Omaha for girls.
Okay, and Ramey, certainly he's always very clever with his language and makes his points. Tell us about some of the data, though. What are we seeing between passive funds and active funds?
Yeah, really interesting stuff here. Let's go into the Bloomberg because I want to show you this bar chart that compares passive assets to active assets in the U.S. here. Blue is passive assets, and in just the past quarter or so, $4.3 trillion is where we stand in terms of passive assets. Now, that compares with $5.1 trillion in active assets for the first quarter of 2017. But look at how much the blue has grown ever since 2009. It is now, in the past 7 years, at its highest. Now, the yellow has actually started to come off from 2015 or so, as we start to see investors redeem some of those monies out of those active funds. And in fact, looking at passive funds, January for Vanguard actually set a monthly record, another monthly record year on year, collecting $47 billion. Back in 2016, it attracted more than $300 billion. And you can see the share price there of the past year or so, up 23% almost. BlackRock also in 2016 saw inflows of $200 billion. And so this is just the general storyline that we've been talking about over the past several months or so, with passives definitely feeling the boost as actives are getting a pullback here. But interestingly, most active managers have seen money go far, far away. Morningstar, for example, 30 of 50 largest fund companies have actually seen redemptions in 2016, Betty.